Hello, everyone. My name is Barry O'Dowd. I'm the president of Trinity Business Alumni, and you're all very welcome to today's webinar in conjunction with the Trinity Business School and Trinity Alumni on investing in a sustainable future. We are delighted to bring you a great panel of speakers moderated by Professor Martha O'Hagan-Luff, who will introduce her panelists, Kathy Ryan and Cynthia DiBartolo. The webinar today will last around 50 minutes, including some questions and answers with you, and we should conclude prior to 2 p.m. The webinar is also being recorded, and if you are watching on Zoom, you will receive a link to the recording shortly after the webinar concludes. The recording will also be available to view on the Trinity Business Alumni website, tba.ie. Now, I'd like to introduce you to our moderator, Professor Martha O'Hagan-Luff. Martha is an associate professor of finance at the Trinity Business School. Her PhD is in international finance, and her research spans behavioral finance, entrepreneurship, and sustainable finance. And she has numerous publications in many reputable journals. In 2020, Martha won the Provost's Teaching Excellence Award. Prior to academia, she worked in investment banking in London and Dublin, where she specialized in derivatives and financial engineering. Before handing over to Martha, I'd like to share with you that Trinity Business Alumni has some fabulous plans moving into the academic year. And I have a couple of them highlighted here. For instance, on the 1st of December, we will have a networking session with an author, Maria Gallo, who will be launching her book, The Alumni Way, in conjunction with the well-reputed networker, Kingsley Aikens, and that's on the 1st of December. On the 6th of December, we will be co-hosting the TBS Business Forum and our own Christmas drinks, where we will have a number of exciting guests present, including our Olympian, Afric Kyo, who recently won a medal at the Olympics for rowing, and she will be interviewed by Irish rugby icon, Jamie Heaslip. Into the new year, in February, we have a dinner in camera, and Nick Ashmore, the director of the Ireland Strategic Investment Fund from the NTMA, the National Treasury Management Agency, has agreed to be our guest speaker. And finally, just to say that in May, on the 12th of May, we will have the President's Dinner, where we have the CEO of Allied Irish Banks, AIB, Colin Hunt, as our keynote speaker. So an exciting year ahead, and many other events besides that I haven't gone into. I would encourage you to please stay in touch with the alumni and make sure you're on our mailing list. Also, please note now, just before finally handing over to Martha, please note that we are using Zoom-generated automatic subtitles for the webinar. These can be switched off by clicking on the CC closed captions button at the bottom of your screen. And then you can choose to click show or hide should you want the captions. So with no further ado, over to you, Martha, and I look forward to a really exciting webinar. Thank you.
Thanks, Barry. Thank you very much, and a warm welcome to everybody who's joining us today for this webinar on sustainable investing. As Barry mentioned, I am based in Trinity Business School, and I'm delighted to moderate the discussion today. And before I introduce our two speakers who we're delighted to have with us today, I would like just to briefly mention the role that business schools can and I believe should play in transitioning to sustainability. Myself and many of my colleagues in the business school are keenly aware of the role that education must play in transitioning to a more sustainable future. We know that we would be doing our students a disservice if we weren't to move towards transitioning to teach business modules in a way that incorporates environmental and social values rather than the more narrow focus on financial values up to now, and to move away from models which prioritise shareholders over other stakeholders with limited incorporation of the externalities that are caused by businesses and are not priced into their products and services. We know that we need to equip our students with the skills to find new ways of doing business and ways of providing finance to those businesses that will enable future generations and our future students to prosper, while at the same time fulfilling the very important need of protecting and repairing the damage that has been done and continues to be done to our natural world. To this end, we know that we need to take a much more interdisciplinary approach to our teaching and research. And we know that we need to link finance and business with other disciplines, and specifically within the university, to use and incorporate the ecological and scientific expertise that exists across the university. And so that's something that we are currently engaged in at the moment in our teaching and research at the business school. But now we will hear from two speakers who are working in the area of sustainable investing. And I'm delighted to introduce, we're joined by Cathy Ryan in Dublin and by Cynthia DiBartolo from New York to give us their perspectives on this really important topic. So just a brief introduction to our speakers. I'm delighted first of all to introduce you to Cathy Ryan, who is the Head of Responsible Investment at Irish Life Investment Management in Dublin. Cathy is also the Vice Chair of the Carbon Disclosure Project in Ireland. Prior to working in Irish Life, Cathy worked at Aviva Investors as a Senior ESG Product Strategist with responsibility for ESG integration across asset classes. Cathy also founded Global Green Investments in 2013, which was an ESG research and analytics firm. And that firm worked with key clients such as the World Bank and the Carbon Tracker on climate risk and investment assessments. Cathy has a long track record in providing thought leadership, including advisory to the European Parliament on green bond developments and to the UK government's Global Innovation Lab for climate finance. So we're really looking forward to hearing from Cathy. Our second speaker, we're delighted that Cynthia DiBartolo is the founder and CEO of Tigress Financial Partners, and Cynthia's joining us this morning from New York, or morning time in New York for her, afternoon for us. Tigress Financial Partners is a woman-owned and operated financial services firm sensitive to people with disabilities. And Cynthia founded this firm after battling head and neck cancer in 2009. Tigress is a fully licensed investment bank, broker-dealer and registered investment advisor. And the firm is dedicated to the principles of diversity and inclusion. History was made in July of this year when they became the first disabled and woman-owned floor broker and member of the New York Stock Exchange for the first time in its 229-year history. Cynthia is also the chairperson of the civil rights movement, the Rainbow Push Coalition, and she's chairing the steering committee for financial services within that movement. She's also the founder and chairperson of the Diversity Broker, Dealer and Asset Management Coalition. And if that wasn't enough, she is also chairperson of the Greater New York Chamber of Commerce. So I would like next to hand over, so each of our speakers will give a short presentation describing their investment philosophies and strategies. And after that, we will have a Q&A with the audience. So I'm going to first hand over to Cathy, and Cathy will describe Irish Life's approach to responsible investment and how this approach is applied to the funds that they manage.
Great. Thank you, Martha, and thank you to the Trinity Business Alumni for inviting me to speak today. Yes, as Martha said, I'm just going to talk briefly really about Irish Life Investment Management's approach to responsible investment, to maybe talk a little bit about what levers we have in terms of targeting sustainable outcomes across asset classes, and then specifically at the end to talk a little bit about how we're integrating climate considerations, given that we are less than a week away from COP and it's a very big topic at the moment on the agenda for a lot of people. So thank you. So actually, so here on this slide, I suppose what I wanted to maybe mention overall, so our responsible investment approach has an outcomes focused approach, and it's driven really by these two overarching mega trends. So one is the trend towards decarbonization, capturing the global trend towards a lower carbon economies. Secondly is the trend towards a more stakeholder-centric business model. really reflecting, I suppose, increasing demands on companies to act responsibly for all stakeholders. So including employees, communities, supply chain, as well as shareholders. So our approach really is it's a research-led focus. And within these core mega themes, we structure our activity around 4 sub-themes. So these are climate change, natural capital, human rights, and corporate governance. And then each theme is structured and implemented to ensure alignment with international frameworks and best practice. Now, as asset managers, really, we have 4 levers in our toolbox in terms of how we execute responsible investment strategies. These are exclusions management, ESG integration or integration of environmental, social, governance factors into the investment decision and solution design. Thirdly, active ownership in terms of our voting and engagement activities. And then lastly, macro system engagement or policy advocacy. So I'll just talk a little bit about each one. In terms of exclusions, so ILIM really has an exclusions policy that aligns with the concept of do no significant harm. And it incorporates climate-specific screens in addition to screens on companies in violation of global standards, such as the UN Global Compact, companies involved in controversial weapons and tobacco, as well as key players in coal power generation and unconventional oil and gas extraction, such as thermal coal producers and Arctic oil and oil sands extractors. The second lever we have really is ESG integration in terms of our investment management decisions. And on this, really, we use both internal and external resources. So we partner with an external data provider, Sustainalytics, to access ESG data on thousands of companies worldwide for scoring and ranking. And then we integrate these ESG and climate metrics into our standard enterprise risk management framework to explicitly capture the sustainable metrics so that we can measure the effect our decisions have in terms of sustainable outcomes and monitor that going forward. How do we do this, I suppose, consistently across equity and corporate bonds? We've actually developed a proprietary model, and we think this is very key, particularly in index management and quantitative management strategies, whereby we use the ESG and climate metrics as a standard part of our process to ensure consistency across corporate bonds and sustainable equity funds. So we do this in a number of steps. So firstly, we apply the ILIM screen as discussed, incorporating the climate specific and norm violation exclusions. The second step is we apply an ESG best in class tilt, where we exclude ESG laggards and we reassign the capital to companies with higher ESG ratings. Finally, we apply a decarbonization tilt, and this tilt incorporates both forward and backward-looking climate data. So just to maybe speak a little bit more about this particular tilt. So the tilt really is designed to reduce exposure to potential stranded assets and to increase exposure to companies which have better alignment with the low carbon transition. So we apply this decarbonization tilt by using a number of metrics. And these are, so fossil fuel reserves exposure, where we create a negative tilt away from companies with high fossil fuel reserves. And we use a green revenues or carbon solutions metric to create a positive tilt to increase allocation to companies with higher green revenues. Then we also use the backward-looking carbon intensity of revenues data and a forward-looking carbon risk rating. Now, this forward-looking carbon risk rating really provides us with critical insights into how companies are prepared for the transition to the low-carbon economy. And it provides us with this forward-looking analysis of carbon-related risks at a portfolio and a company level. As a result of incorporating these tilts, I'm sorry, if you don't mind, it's actually just 2 slides on. So this briefly summarizes, I suppose, the tilt approach I've just described. On the following slides, the question is, what is the outcome of this approach? So if we could just move to slide 4, please. So the outcomes of these 2 tilts really, according to Sustainalytics analytics, this process then results in 21% less exposure to stranded assets, 64% less exposure to companies with severe carbon risk, as well as 20% higher exposure to companies with green revenues, and approximately 31% improvement on the carbon intensity versus standard market cap benchmarks. So this is what we're targeting within our approach, is that we have clear outcomes that are measurable and can be managed and monitored on an ongoing basis. Maybe just to mention, so the third lever we have in the toolbox is active ownership, or voting and engagement. So we use our stewardship activities really to accelerate the alignment to the decarbonisation agenda and also to the shift towards more stakeholder-centric business approaches. We're also engaging collaboratively with other investors, and we're members of a number of collaborations together with the PRI, the Carbon Disclosure Project, Climate Action 100+, Institutional Investor Group on Climate Change, etc., to enhance this behaviour within the companies we invest in. For example, within the Climate Action 100+, which is an initiative that focuses on 167 of the largest carbon emitters in the world, there has been huge pressure on them to develop climate targets and an alignment with net zero. And at the moment, 110 of those companies have now set net zero targets, primarily due to investor pressure, due to the actions of the Climate Action 100+. And the targets that they've set currently amount to approximately 9.8 billion metric tons of CO2 collectively per annum until 2050. So if these targets are actually met, this is a very impactful shift we've seen in underlying company behavior. Then the last lever is policy advocacy, and it is a very important one, and what we would term system engagement. So what we are doing is really interacting with policymakers, investors, and industry groups at large to ensure that this alignment with climate goals as well as the Sustainable Development Goals is on a clear trajectory. We work, for example, with the UNPRI, Sustainable Investment Forum Ireland, CDP, etc., in aligning our activities and creating working groups to inform both government action and also to help moderate the actions of the financial sector. So in particular, for example, in 2021, we signed the Global Investor Statement to governments on the climate crisis, which is an ambitious statement to governments ahead of COP26, calling for a number of measures, including significantly stronger 2030 nationally determined contributions, credible commitments to the net zero gas emissions by mid-century, and lastly, the development of just transition plans for affected workers and communities. So I suppose just to wind it up, what's very, very important, I suppose, is that we keep track and we verify the sustainable outcomes that we are targeting. And for us, that means really that within our investment risk team, we've developed an independent function which identifies, measures and monitors ESG and climate risks across our investments. So we've just released our first TCFD, or Task Force on Climate Related Financial Disclosure report. I think we're the first asset manager in Ireland to do so. And this report really is a firm-wide climate risk assessment of how our investments align with various climate scenarios. This is really a stress test, and our stress test is based on 3 scenarios which were provided by the International Energy Agency. Those scenarios are, for example, the Sustainable Development Scenario, which is fully aligned with Paris and should keep temperatures well below 2 degrees. The stated policy scenarios, which assumes policy intentions and announcements that have been made actually come to pass, but it still implies a warming of approximately 2.7 degrees. And then lastly, the current policy scenarios, where we're expecting no change in policies, and this really implies a temperature increase of approximately 3.2 degrees. So for us in our TCFD report, what we did was really analyze each company's carbon budget in terms of how it's defined based on its market share. And then the scenario analysis really allowed us to compare current and future portfolio greenhouse gas emissions with the carbon budget of these 3 scenarios. And the results that we found are that for our discretionary investments, where we have the license to integrate our ESG approach, the climate metrics of the weighted average carbon intensity and the relative carbon footprint strongly outperform the standard market benchmark. So for our discretionary assets, the portfolios have over 31% lower relative carbon footprint and 36% lower weighted average carbon intensity. And they also have an implied temperature rating of about 2.3 degrees versus the standard benchmark of about 3 degrees. So going forward, we see that the climate analytics, the TCFD, and the analytics capability that are developed using these data sets really provide us with the capability to create robust climate targets and put us on a path to net zero. We're going to use, I suppose, the sustainable development scenario as an assessment of how this emission trends of the portfolio will align with net zero, as it has a similar emission reduction transition pathway. For us, really, I suppose what is key, we have currently transitioned approximately 34 billion of our assets under management to climate and sustainability focused portfolios. And incorporating environmental, social, and governance factors into our investment processes has to be consistent with client mandates. So certainly for us going forward, working with clients to educate and engage with them in terms of what sustainable and climate risks are currently incorporated in their portfolios and what those journeys should look like and what their ambitions and aims are, is a key to our work going forward. So maybe I'll leave it there and take any questions after.
Thanks so much, Kathy. That was really fascinating to hear how you're transitioning, how you're trying to do this on the ground. So it's a very interesting presentation. Thank you very much. So I'll just hand over now to Cynthia next to give your perspective on ESG investing. It would be lovely to hear from you, Cynthia. Thanks.
Thank you, Martha. It's a pleasure to be here today. I'm very excited to be at the pinnacle and really the forefront of both social responsible investing and ESG. There's no greater time for a call to action for every one of us, whether we're aligned on the private side, on the state side, or as individuals. And we've learned quite a bit over the last few years. And despite the fact the evidence has been there for decades, I think we've been somewhat willfully blind to environmental challenges that lie ahead that will be catastrophic if we do not all put a proactive step in being part of the solution here. I mean, one of the things that people like to think is, well, who's really, at the forefront of this? Is it government? Is it business? Is it the individual? Well, if we look at government, the climate pledges that have been made by government to date, even if fully achieved, would fall really short of what's required to bring the global energy-related carbon dioxide emissions to net zero by 2050. And really, it would nearly be impossible for the world to limit global temperature rise with what we're looking at in terms of the pledges. So that would need to change and be ramped up considerably. In my opinion, many governments would fail because you simply, in government, are dealing with legacy, and governments will try to tackle 21st century problems with 20th century solutions, which is an immediate failed response. And we all know government is far from innovative. So rather than leaving our future in the hands of government, I believe that the global success in achieving this critical goal rests in a holistic public engagement of government, of corporations, individuals, and communities, all being at the heart of shaping a place-based transition to net zero by 2050. If we can move to the next slide, thank you. Public engagement, is kind of this phrase that is a challenge when we think about it, because I think the average individual doesn't understand what it means in the totality of that. Next slide, please. Public engagement is actually, it is one of the most aggressive ways to achieve the success in our climate initiatives, because it enables a multi-level, multi-sectional partnership and collaboration across government, business, civic organizations, and the individuals who comprise our communities. It supports changes in thinking. It will demand shifts in values, and it will require rehabilitative behavior through sustained long-term public engagement. Next slide, please. Now, we're also kind of looking at, well, who's going to take the lead in this activity, right? Where does it start? Who kind of sounds the horn in terms of setting up the players on the field? And it's again takes everyone. Climate change is a planetary scale threat, and it requires planetary scale reforms that first need to be implemented by government. However, individuals must be responsible for their own behavior. And we have learned, and we certainly recognize, that governments have the power to implement legislation that compels individuals together with corporations and industries to act sustainably. Bolder actions and a whole of government approach will be needed. Think about it for a minute, Martha. Greenhouse emissions, gas emissions, are embedded into every aspect of our daily lives, in energy production, transportation, building, agriculture, manufacturing, supply chains, consumer products, and far more. Local and individual efforts are critical, but ultimately, broader transformations of our society are going to be needed. It's kind of a system of systems problem. When you really start to do the homework on this, the learnings are frightening. And they're also embarrassing, because at the very core of this, corporations produce just about everything we buy, use, and throw away. And therefore, they play an outsized role in driving global climate change. But even more critical to this is that just about 100 energy companies have been responsible for more than 71% of all industrial emissions since human-driven climate change was effectively recognized. The public investor-owned companies include Exxon, Mobil, Shell, BNP, Chevron, state-owned companies such as Saudi Aramco, Iranian Oil, Coal India. And now if we could get those companies, those 100 companies, to become keenly focused in how they do business, changing the way they operate, making climate change at the very heart of how they operate, we can make some radical changes. And I think, this aligns with, on the investment side, where we see a considerable amount of dollars on the ESG side being piled into the space, especially in electric vehicles and batteries, which could certainly go a long way in helping us obtain the climate change goals we so desperately need. Thank you. Corporations also, when we look at government versus corporation, one thing we know, corporation can move a lot quicker than the government can in playing their role. While government is quick to cite a thesis of things that they will set out to do, they are often riddled with political challenges that delay their execution and overall impact. Today, as a result of the pressing ESG environment, and for those that are on the phone, let me just say ESG relates to a company's environmental, its social, and governance practices. Well, corporations today cannot escape the fact that investors are demanding that they participate and they be accountable. You see investors vote with their wallet, which directly impacts corporations. Consumers vote with their wallets, which directly impacts corporations. So we as individuals have tremendous power in our hands to certainly compel each of these companies to pick up the mantle and do what they have to do to be part of a sustainable and impactful change. You know, the last close to 2 years has been an incredibly challenging, life-changing event for all of us on a global basis. The pandemic forced us to look at our lives, adapt in ways we never thought possible. We recognize that there are tremendous vulnerabilities driven by nature itself. And the power of nature can sometimes be insurmountable. And oftentimes, like COVID, you know, people think it won't impact them. This is happening elsewhere. I can't possibly be infected or suffer the symptoms that will have potentially catastrophic impact on my life and that of my family. Well, the same holds true for climate change. There is no question that we need to look at what we've experienced globally through the lens of COVID-19, our reaction to the pandemic on the level of government, corporations, and individuals, and how we address that. We learned some incredible lessons from that. Next slide, please. We learned that human behavior does only responds to emotion, not science. Academics understand science. Sophisticated individuals understand science, but by and large, across a global scale, science is somewhat alienating to individuals. And therefore, unless you can encompass science in terms of how to drive human emotion, you cannot possibly engage the public at the level that you need. Emotional responses drive people's actions to get politically engaged. They drive, emotional responses drive individual reactions to change their behavior. So it's critical that science learn how to help visualize what they're talking about so that it translates into emotion. And therefore, we can get the buy-in globally from individuals that can be part of the solution. What we also learned coming out of COVID-19 is that there is always this great debate over economy versus the cost of human lives and jobs. So what we know is climate action does not inherently conflict with economic growth. Rather, they are intrinsically linked. You see, for us to have a healthy economy, we must have a healthy climate. And therefore, the debate that we have suffered over the last 2 years, I think is somewhat mute at this juncture. We recognize that in order to achieve the levels that we need in climate change, that it will, our economy is on parallel with that, and we cannot separate those two and bifurcate them. We also learned that the pandemic was devastating both globally and economically across the world, but it disproportionately impacted the poor and deepened existing inequalities. Well, this holds true for climate change. The challenges ahead of us with respect to failure to achieve net zero will inarguably disproportionately impact the poor and issues of inequality that we're already faced with. We will all feel it, but it will be felt in those marginalized communities and those marginalized parts of the world much sooner and with much greater impact. What we also learned in coming out of COVID-19 is that the delay to act is costly. It's costly in terms of dollars spent and mitigating the issue. It's costly in terms of the human capital that needs to be deployed. It's costly in terms of accelerating the science that's needed behind it. And it's costly in terms of the lives that were sacrificed. So delay is not an option. And the final point I think that's critical to this is that COVID-19 proved that public and private partnerships on a global scale can deliver against all odds. And there is no question that we are at facing some of the greatest odds of achieving a level to control climate change and achieving net zero. So rather than be a part of the community that is disenfranchising the prospect of the value of public and private partnership, we all need to embrace it and find the role that we play within it.
That's great, Cynthia. Thanks very much for a really interesting presentation, and you made some really very fascinating points, you know, particularly about behavioral aspects, and behavioral finance is something that we've been focusing on, but to try and apply what we know about behavioral finance to the challenges, I think is a very interesting point. I would just like to encourage anyone on this call, if you have questions for our speakers, to please use the Q&A rather than the chat. So we'd be delighted to take questions from the audience at this point. So like I say, please do feel free to type in your questions. So we have a few questions in already. Jim Bracken, thank you very much for putting in a question. And I think this is, so the question asks, what tools are you using to assess the transparency of upstream supply chains of quoted companies, especially in the food and garment sectors? And I think this speaks to the difficulty of measuring what are known as Scope 3 emissions. But I will pass this question on to Kathy, if you would like to have a go at answering Jim's question.
Yeah, sure. So Scope 3 emissions, I suppose it's very much, you know, that area at the moment is, I would say it's rapidly evolving. The data set itself has, you know, suffered from a lot of inaccuracies and double counting, etc. But we have improved metrics on it, I suppose, as companies are starting to disclose more in that area. So we work with 2 external data providers to help us to assess upstream supply chains. And so from a Sustainalytics point of view, their data set now has, it's expanded to a universe of almost 5,000 companies. It still has certainly quite a number of areas of gaps, but it's improved dramatically. I suppose what's important for us as an external validation of how we look at our overall portfolio, we're using a second validator of that in terms of ISS and their data set, and their estimation technologies on scope 3 assessment is actually very good. So that's probably one of the main ways at the moment we're using it, but I would say we're using it less at the moment in terms of portfolio construction and more in terms of risk assessment and in identifying hotspots within the portfolio. But it's definitely something, a sort of key concern that we're sort of watching carefully as to new evolving data sets and how we can track that more carefully.
That's great. Thanks, Kathy. There's another question in from Reshma Amir Hamza Abbas, asking about the ESG factors currently being considered by Tigress Financial Partners and Irish Life when analysing the companies for investing. And if you don't mind, I might like to add to that question a little bit. Cynthia, you know, as one of the very few female-owned, and certainly I think the only disability and female-owned financial company in the US, you might speak to the importance of diversity and inclusion in sustainable investing, while also answering Reshma's question about the ESG factors that are considered by Tigress Financial Partners.
Yeah, absolutely. First of all, you know, to be authentic in the ESG space, and we have an obligation, you know, with great power comes great responsibility, and we have an incredible responsibility to be authentic to who we are and what we represent in our mission statement. As part of ESG, Tigress plays a critical role on many fronts. One, internally, we have to ensure that our workforce, our ownership, are in line with the ESG mission, meaning 90+% of our ownership is held in the hands of women, and 93% is held in the hands of disabled individuals. And our workforce, 80% of our workforce represent African American, Hispanic, women, and disabled professionals. That is key, and that is very, very different than what you would see in most corporations. Secondly, our client base. We have an obligation to be part of an ecosystem that represents opportunities for client base not to be marginalized when it comes to access of the markets. Actually, our role is in democratization of the markets and playing a key role in doing that. We have an external commitment on the philanthropy and community side as well. It cannot just stop internally. We have to make sure that we are engaged within our communities, and those communities are expansive across the US. For us to do it on a broad scale, Tigress specifically partnered with the Durant Center, which is Kevin Durant, the iconic NBA player, and we are facilitate financial literacy and ensure that we are driving up financial literacy so that we can change the trajectory of the lives of children and women in the inner cities and in communities of color, so that we provide them with an opportunity to change what's in front of them, right? And there is no deficit of talent among women and people of color. The deficit is in the opportunity presented to them. So our role is critical in that. Now, let me segue over to the investment side and where we play a critical role. Tigress has been, for instance, and this is something I think your listeners could relate to, IPOs are incredibly important, right, in driving our markets. And I think there's no more attractive space that the individual investor finds himself in is tracking IPOs. And if you give me 1 second, I just want to shut this because we are being challenged with a lot of light, sun coming in right now. And honestly, it's been an incredible opportunity for Tigress to play a role with these corporations. In just the last 2 years, we have been in over 600 transactions with a $300 billion transaction value. Names such as Lyft, Airbnb, the hotel chains, some of the biotech companies that are out there. We underwrite corporate bonds for whether it's MasterCard, McDonald's, looking at the opportunities that are presented by these corporations. Now, why do these corporations themselves want to align with a diversity firm? Plain and simple, as part of their ESG initiative. They're trying to less about the E, the environmental, but much more about the S and the G. So corporations today and have really tried to find a role for diversity-owned firms to be part of the capital markets transactions.
Great, thanks, Cynthia. I'm actually going to jump to a great question here by Jaden Yim, because actually this is something that came up in a previous kind of preparatory call, something myself and Kathy in particular were discussing. And I mentioned, you know, our role as a business school in educating graduates, that we feel that we need to provide the skills that are needed in the workplace. So Jaden's question is, from a career perspective, would there be more junior positions for fresh or recent graduates? Which skill sets are indispensable for a career in sustainable finance? And how can students better equip themselves? What professional qualifications would be desired in this space? So Kathy,
that's a genius question.
It's an important question for all of us, me in particular, but also to hear from industry would be excellent. So thank you for the question, Jaden. Kathy, I'll hand over to you, or Cynthia, you can jump in too, of course.
I might just say a few things. I mean, it certainly, you know, this is an area, I think it's been recognized as the fastest growing area in finance currently. And certainly within the asset management sector, it's you know, it is growing exponentially, both in terms of asset flows, but also in terms of client demand, and from asset owners, it's increased pressure, I suppose, to demonstrate how they are aligning their mandates really with sustainable goals. I would, and you know, clearly, you know, having worked with a lot of professionals across this area, it really involves everybody within the financial system. So what is wonderful to a certain extent, I'm echoing Cynthia's point here, is that this is everybody's job, you know, and you know, as anecdotally, when I arrived in Irish Life 18 months ago, we were building out the team, etc. It, you know, very rapidly became clear that the size of the implementation meant that everybody within each team had to have a point person, an ESG, what we call ESG champion within each team, to ensure that the ESG approach we were taking was monitored, measured, fund managed, you know, externally communicated, etc., as we needed to. So I would say it includes all skill sets. And I think there's a great lesson, I think, for anybody who's undergoing finance. I think that this should be a mandatory part of the course. In particular, it's very, you know, having the skills, the analytic skills, as many people do in finance, to understand regulatory backdrops, frameworks, the conceptual underpinning of, you know, what we're doing and what the research we're relying on, as Martha mentioned, I suppose, particularly with relevance to the science underlying each theme, etc., is very useful, and I think is you know, increasingly critical, I suppose, in terms of being able to establish yourself. And but I think, you know, I think there's a very wide range of skills that can be needed, from everything from quant fundamental analysis, company level analysis, through to thematic approach, and understanding of government operations and policy development is also really key. There are a lot of applications, so I would say this. You know, looking at specific courses on this, you know, on sustainability, specific niche areas which align with existing and current skills that one has, I think would be a really good way to go forward.
Just to augment what Kathy said, I believe that our success in sustainable investing lies in diversity of thought. And diversity of thought is truly the final frontier of diversity and inclusion. So in order to really have proper diversity of thought, I need individuals within my organization from all different backgrounds and with different levels of expertise in different sectors. It is critical to have somebody obviously with some statistical expertise, somebody with some finance expertise, economic expertise, science expertise, marketing expertise, risk management expertise. All of this folds into each other. You see, if we build an organization that is simply top heavy with everyone who's a quant or everyone who's a statistician, okay, we'll have a lot of great information, but we will never know how to share or apply that information, because it's diversity of thought that makes you innovative, and how you take your learnings, how you take the data, and how you make it meaningful and impactful.
That's great, Cynthia. Thank you. Lots more really interesting questions here, and I hope we'll get into enough of them. So in order to not run out of time, I'm just going to incorporate a few. So Patrick Thorpe has asked about early champions in the ESG space, and I would say both of you could lay claim to that. Irish Life, as Kathy mentioned, were one of the first asset managers to report using the Task Force for Climate Financial Disclosures. And of course, Cynthia, you're the first and I think still only financial asset manager incorporating diversity and inclusion. Sorry, to that, I'm going to link that in with the question from Joe Borza, who questions about sustainability reporting, whether it should be embedded into financial reporting or standalone. I don't know if either of you want to jump in on that, and I think it's probably safe to say, I assume integrated would be the way.
I'm just going to jump right into the deep end of the pool on that one. It's got to be incorporated. It has to be transparent. What does not get measured does not get counted. What does not get measured does not get counted. It has to be transparent. It has to be impactful. And until we get to a point where there is true data transparency, okay, we will never really achieve what we set out to do. Okay, without that, we have a lot of white noise around initiatives that look great in annual reports. They read well. They look beautiful pictures on websites that look impressive, but yet tell me what the results are and where the change is. So it is critical that it be there be disclosure and transparency.
I might add to that if I could.
Please do, Kathy.
Yeah, so I would reference, and I think this is, I agree with Cynthia, but I think what's really encouraging to see is that the European Sustainable Finance Act has really, implemented a range of disclosures requirements for companies, which is incredibly well, from an architecture perspective, is incredibly well crafted. So the interlocking of the non-financial reporting directive, which is going to ask corporations to comply with the taxonomy regulation, the taxonomy being a set of regulations which explicitly defines what is deemed a green activity, and to the very small infinitesimal calculations, what a company can deem to be a green activity. And requiring companies to have such a prescriptive disclosure within their regulatory disclosures is really key. But it's not only key for corporations, but it's also key for investors like us. So we rely very much on the external disclosure of companies. So given that we're being impacted by the Sustainable Finance Disclosure Regulation, which asks us to clearly state what are the outcomes and impacts of our sustainable actions in terms of our funds, and to disclose that on our regular fact sheets, both to clients and to regulators. And this includes principal adverse impacts, sustainability risks, etc., that are incorporated in the products that we sell, as well as defining whether the product is actually sustainably integrated, what we call Article 8 product now, or has a sustainable impact outcome as its target, or what we call Article 9 products. The fact that the European Commission has been able to set this level of regulation across the financial sector, as well as in a consistent manner across corporate required disclosures, is really, I think, beginning to clarify what we deem as sustainable, how it's defined from a policy level. And I think we are, as a result of that, we're actually starting to see really big shifts across the industry. So yes, very much agree with official regulated disclosures.
There are still some really interesting questions, but I'm just conscious of time and needing to hand back to Susanna Doyle from the Trinity Business Alumni to wrap up. And I apologise that we haven't gotten to the other questions, because I feel like this could go on for another hour and it's a fascinating topic. But I would just like to really, really thank Kathy and Cynthia for your very interesting perspectives that are great for those who've joined, but also for us in the education sector. So I'll hand back to you, Susanna.
Good afternoon, everybody. It's been so fascinating. I've been looking forward to this webinar for a couple of months when we first started talking about this topic. So really a huge thank you to Martha for helping to moderate and organize, to Kathy and to Cynthia for being here and sharing your views. It's been fascinating. As Barry mentioned earlier, this will be available in a recording on the TBA website, and we'll also put it on the Trinity Development and Alumni YouTube channel as well, so you'll be able to view it. I wanted to thank Barry, who is the president of the TBA, for pulling this all together, and to my colleague, Alex, who has been in the background, who's been helping along throughout this webinar as well. So thank you to all of you. As Barry mentioned, there are a number of different TBA events that are coming up in the coming months, and there will be invitations that will be coming out in the next few weeks for those events that are happening in December. If you have more questions about the TBA, you're welcome to visit the website, tba.ie, and you can follow us on LinkedIn. If you have any questions for the Trinity Development and Alumni, please email us at alumni@tcd.ie. We also have the URLs here for the Business School, for Tigress Financial Partners, and Irish Life Investment Management, and these will all be sent out to you as well in the follow-up email. So thanks again to everybody. Big thank you to our speakers. That's been fascinating, and look forward to seeing you all again soon. Take care.